Imagine waking up tomorrow and seeing silver at $80 an ounce. Not 30, not 40, 80. Now imagine the biggest banks in the world reacting, like their survival depends on stopping it, because in many ways, it does. This is not just about a metal. This is about leverage, psychology, and a price level that some institutions fear more than a recession. Right now, there is a quiet battle happening around one number, 82 regular investors. It looks like just another round number. But inside trading desks, risk models, and margin departments, $80 silver is a potential trigger point, a line in the sand, a level that could turn paper profits into panic. Before we go deeper, if you enjoy stories that break down money, power, and the hidden mechanics behind markets, make sure you like this video and subscribe to The Monetary Shift. It really helps the channel grow and keeps these deep dives coming. Let's start with something simple. Banks don't just bet on silver going down or up for fun. They operate in complex systems of hedging, derivatives, and short positions. Many large institutions participate in the futures market through exchanges like the COMEX, where silver contracts are traded in massive volumes. When silver stays in a predictable range, everything works fine. Traders manage risk, positions roll over. Volatility is controlled. But when a price approaches a historic high like the 2011 peak near $50, memories come back. And if it pushes toward 80, that's not just a breakout. That's a psychological explosion. Back in 2011, during the commodity boom fueled by global stimulus and fear after the financial crisis, silver ran close to $50 per ounce. It happened fast, and when it reversed, it was brutal. Many traders were wiped out. Margin requirements were raised. Volatility crushed positions overnight. That episode still shapes how risk managers think today. Now imagine silver doesn't just test 50 again. Imagine it breaks through. Momentum traders jump in. Retail investors pile on. Social media lights up. Influencers call for triple digits. Suddenly, 80 becomes the next target. And here's where things get uncomfortable for certain banks. Large banks often act as counterparties in derivative contracts. They may hold short exposure as part of market making or hedging operations. A rising price means losses on those short positions. If the price rises slowly, it's manageable. If it spikes quickly toward 80, it can trigger margin calls. A margin call is simple but deadly. It means you must add more money immediately to keep your position open. If you can't, your position gets liquidated. When multiple players face margin calls at the same time, forced buying can drive prices even higher. This is called a short squeeze, and that's the real fear. Not just higher prices, but a feedback loop. At $80, the narrative changes. Silver stops being undervalued metal and starts becoming monetary rebellion. It becomes a symbol. During periods of distrust in fiat currency or heavy government debt, metals gain emotional power. Investors start asking uncomfortable questions about inflation, deficits, and currency stability. In the United States, the role of the Federal Reserve is central to this story. When interest rates are low and liquidity is high, precious metals often gain attention as stores of value. If inflation fears rise while rates lag behind, silver can move aggressively. Now, think about psychology. Markets are not just math. They are human behavior multiplied by leverage. Round numbers matter, 50 matters, 100 matters, and 80 sits right in the middle of disbelief and euphoria. If silver hits 80, headlines will explode. Financial networks will debate whether a new commodity supercycle has begun. Retail traders will compare it to the gold run. Some will even bring up the old silver squeeze attempt linked to the Hunt brothers decades ago, a story that still echoes in trading lore. But for banks, this is less about drama and more about balance sheets. Rising silver prices increase volatility. Volatility increases margin requirements. Higher margin requirements increase capital strain. Capital strain forces risk reduction. Risk reduction means buying back shorts, and buying back shorts at high prices hurts. Here's where it gets more interesting. Banks also operate in interconnected markets. Silver is tied to gold, gold is tied to currencies. Currencies are tied to interest rates and bond markets. If silver breaks 80 because investors are fleeing fiat currencies, that signals deeper concerns about monetary stability. Bond yields could react, the dollar could weaken, inflation expectations could shift. Suddenly, What started as a metal rally becomes a macro event. On top of that, silver is not just a monetary metal. It's industrial. It's used in solar panels, electronics, and electric vehicles. A supply squeeze combined with investment demand could create real physical tightness. If physical premiums rise while futures spike, the disconnect becomes visible. When physical buyers start paying significantly above paper prices, trust in the paper market gets questioned. That's another psychological trigger. Now, think about leverage again. Many trading desks operate with models that assume historical volatility ranges. If silver moves outside those ranges, risk models force automatic adjustments. That means selling other assets, raising cash, reducing exposure, contagion spreads. This is why 80 feels like more than just a price. It's a stress test. It tests how much short exposure exists. It tests how resilient clearinghouses are. It tests how investors respond when a metal associated with monetary fear starts acting wild. And here's the twist. Sometimes, the defense of a price level becomes visible. You may see heavy selling near key resistance. You may see sudden spikes down during thin trading hours. Are those normal market moves? Often yes, but when a level carries huge psychological weight, every move gets interpreted as intentional. Markets run on perception. If traders believe that someone is defending 80, they trade differently. If they believe a breakout will cause chaos, they position for it. The idea of banks defending 80 is not about secret meetings in dark rooms. It's about incentives. Institutions protect capital. They manage risk. If a level threatens large losses or systemic stress, they act conservatively. They hedge. They reduce exposure. They increase collateral demands. But here's the paradox. The more aggressively a level is defended, the more explosive the breakout can be if it fails. Imagine a dam holding back water. Every sell order near 80 is another brick. Every short position is extra pressure behind the wall. If the wall holds, prices stabilize. If it cracks, the rush can be violent. Retail investors sense this tension. That's why online communities talk about squeezes. That's why silver trends during inflation scares. It becomes more than an asset. It becomes a narrative. And narratives move markets. If silver were to approach 80 during a time of rising inflation, high debt, and distrust in institutions, the symbolism would amplify the move. People would not just buy for profit, they would buy for protection. That kind of demand is emotional. Emotional demand ignores valuation models. At the same time, regulators watch closely. Exchanges can raise margin requirements. Clearinghouses can tighten rules. These tools are designed to control volatility, but they also change trader behavior instantly. So when you hear someone say, banks are defending 80 like life or death, understand what that really means. It means that beyond that level lies uncertainty, potential margin calls, forced buying, narrative shifts, and stress in interconnected markets. Will silver actually hit 80? No one knows. Markets surprise everyone. But what makes this level fascinating is not the number itself, it's the chain reaction it could unleash. And this is what we focus on here at the Monetary Shift, not just prices, but the psychology behind them, the pressure points, the incentives. If you've made it this far, I'm curious. Do you think $80 silver would trigger a massive short squeeze? Or would the system absorb it calmly? Drop your thoughts in the comments. I read them all. And if you found this breakdown helpful, share it with someone who follows precious metals. These conversations matter, especially in times when money itself feels uncertain. Because in the end, silver at 80 is not just about a metal. It's about confidence. Confidence in currency. Confidence in institutions. Confidence in the stability of a leveraged financial world. And when confidence gets tested, markets don't move gently. They move fast. Stay informed. Stay curious. And I'll see you in the next deep dive here on the Monetary Shift.